Hello and welcome to another segment of Accounting and Tax News brought to you by Freeman CPA and Atlanta Business Accountant. I'm Angie Freeman, IRS enrolled agent and proud mama to this pup right here who is keeping me company and helping me to present today. So today I will be teaching you a real estate investment strategy called BRRRR. Now, if you've never heard of that strategy, BRRRR stands for Buy, Renovate, Rent, Refinance, Repeat. Okay, so here is the gist of the strategy. The first step is to buy a property, and the catch here is we're typically buying properties in this situation that are subprime. They're properties that are not ready to be rented out right away. They're the diamond in the rough or the good investment type of property. They're the kind that your typical flipper will be very happy to have because you can put in some money and make it much more valuable. It's a good investment. And the drawback to those kind of purchases is your conventional banks are reluctant or will not issue a mortgage for such property because it's lacking something. It needs that work to be done first before it's eligible for a mortgage. So for these kind of properties, what we typically do is we will use other sources of funding or cash in order to purchase it. Now, you could, of course, just have cash sitting in your mattress and use that money to purchase your property. But typically what we see in this situation is money that is used from a HELOC or a cash out refinance on your primary residence, using those funds to purchase this investment property, borrowing from friends and family. You can also borrow from hard money lenders. And what that means is there's companies out there that will lend you money at worse terms, but they're looking at the whole deal and evaluating it, not necessarily just the current condition of the property. So if they think that this is a good investment, they will lend you the money. But of course, the terms will not be as favorable. It will cost you more in financing. And then we can also take a loan against your securities, or we can take a loan against your 401k or retirement account. So these are the common strategies for purchasing this property. And I will tell you right now that this is jumping ahead a little bit, but you do not want to use straight up hard-earned cash for these kind of transactions. The reason for that we'll go over in a little bit, but basically cash is going to mean that that transaction will be taxed differently, will be treated differently for tax purposes, and it's just going to be less favorable for us. So we actually do not want to use cash. We want to use some form of borrowing for this, whether it's a HELOC or a 401k loan or anything along those lines. We want to actually have a loan in place when we're purchasing it, just not the standard mortgage because you're not able to obtain it. And one other side note for this buy side is to make sure that your accountant puts on the books correctly the basis for this property. So what we've seen as actual mistakes is when we're looking at the basis for your property, we're looking at your purchase price plus all the closing costs plus renovations, and that's your basis. However, what your accountant will do, and you should be aware of that, is they will split out land value from the building value. Land does not depreciate. The building does. So whenever you're purchasing a property and your accountant is putting it on your tax return, they're splitting out using the property appraisal ratios. So the property appraisal will put out a ratio on the county website typically that states how much, well, it'll state the appraised value and how much of it is land and how much of it is building. And we're just looking at those proportions, and then we're applying that to a purchase price or to your basis, and that becomes land versus building. Now, one important thing to keep in mind here, something that we've seen done erroneously and it cost our clients money, is to take that whole amount, which is your purchase price plus closing costs plus renovations, and that's your basis, and then splitting that out, that percentage to land versus building, and that's wrong. That's costing you money unnecessarily in depreciation. What you should do is you should take the correct way, which will be to take your just the purchase price plus the closing costs. That's the amount that you're allocating to land versus building, because that's what you actually purchased at that time. Anything that you have done after that fact is going to be treated separately, because that's all depreciable. So we can capitalize that whole renovation cost and then depreciate that instead of allocating part of it to land. And then you're not seeing any kind of tax deduction on that amount until you actually sell the property, and that becomes your basis anyway. So that's just something to keep in mind. Make sure your accountant treats it correctly. All right, so the next step after you've purchased it and make sure that it goes correctly on the books is to rehab the property. And that's basically to renovate it. So important things to keep in mind is during the renovations, we have our appliances, we have our longer term assets like HVACs, we have the driveways, the landscapes. All of that will have different depreciation lives. And again, it's very important when we're putting that on the books is to make sure that it's done correctly, that we're using the correct asset lives, depreciating it over the appropriate time as prescribed by the IRS. And we should also discuss with your accountant whether it makes sense in your situation to select bonus depreciation and to or any other accelerated methods, and to basically accelerate it faster versus the benefits of taking the standard depreciation over the term of that prescribed life. Okay, so that's the rehab. Once it's rehabbed, the next step is to rent the property. And when we're renting the property, what are we doing? We're making the actually finding the tenant, and now we're putting it into service. And here the important question is, well, what is the in-service date? That's the day that you're able to actually begin depreciating that purchase, right? Not before. It has to be placed in service. And when is that? So according to the Treasury regulations, section 1167A, so you want to see something that's basically advertisement is one, but it has to be advertised once it's available for rent. You cannot purchase the property, still needs to be rehabbed. You're already advertising it, saying in 6 months it'll be available for rent. No, it has to be available for rent now. You should be able to bring the clients in, potential renters, and you should be able to have them do a walkthrough. So it should be in that final condition. The other thing that's important to look at is in many cases, you'll need an occupancy permit to be issued. So if your county requires occupancy permits, then that's another step to ensure that will tell us that property is now available for rent and is placed in service. And of course, if there's any business licenses needed for this purpose as well, that's another factor for us to consider as placed in service. Once all of these T's are crossed and I's are dotted, that's when it's actually available for rent and is considered to be placed in service. Now, let's see. The next step. Okay, so we've rented it out. There's not much else to that. So the next step is where we refinance this property. So what we're doing now is we purchased our property. Let's say it was $100,000 property. We've put in $40,000 into renovations. So far investment is $140,000, and we rented it out. Now that renovation had made the value of the property now, let's say $200,000, because as I mentioned, it's a diamond in the rough. Putting in money to renovate the property will bring the value up higher than your total investment so far. So now let's say we have $200,000 as your market value for this property. Now you're going to go to the bank and you're going to ask them to refinance that property. And typically what banks will do is they will refinance up to 75% of its value. So now you're able to pull out $150,000 as a loan. You are able to pay yourself back the $100,000 that you originally invested, plus the $40,000 from the renovation. And in this example, you actually kept an extra $10,000. And now you're using this money to invest in the next property. So what's important here is to make sure that you're using the funds for a business purpose. So, and that applies to the well, let's step back. So first we have that 140,000 that you're paying yourself back. That was the money that you borrowed, and now you're able to pay that back. All right, so that becomes a deductible. That makes that first loan and this next loan deductible because it's used for financing or refinancing a business purchase. And then that other 10,000 that you pulled out as extra, it's very important to also put that into a business purpose. Otherwise, that portion will not be tax deductible interest. So again, if you're taking that whole money that you just refinanced, you're putting it back into the next property, then that loan will become also deductible interest for the future. And that's how you continue. And the beauty of this is that you can keep going this way, and you can keep essentially recycling this money and keep purchasing additional properties and growing your business that way. Now, may not be, it's arguable whether this is a perfect time to do this or not, but there's always situations where this strategy can work. It has worked wonderfully in the past, and it's something that can work again for you in the future.